Hey there, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 11th, 2023. I hope you are doing well, and thank you so much for coming and visiting my Week in Review podcast. In the podcast today, the format is as follows. Excuse me. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back and we're going to take a look at all the trades that I took this week or last week, both on the daily and the weekly time frame. We're going to talk about when I bought them, why I bought them, and most importantly, how I am going to manage the trade going forward. Getting in the trade, that's one thing. Looking for your signals, that's one thing. But how to manage the trade as it moves your direction or against your direction is really the important part of trading. And I have spent the majority of the last 28 years as a full-time professional trader looking at my process of how to manage the trade, taking profits, trailing stop levels, emergency stop levels, levels above that have been rejected that may be telling the story that it's time to get out. So anyway, I'll go through all of this in the trades that I've taken this week, and again, how I'm going to manage them going forward. It was a great week. All in all, we had some big ups, we had some big downs, but that's the market, isn't it? After I go through the trades, I am going to talk a little bit about trader psychology. Always the most important part of trading, in my opinion, is the ability to create a plan and then follow that plan without letting the gains or losses get you off of trading your process. Very important. So we'll talk a little bit about trader psychology. Then we're going to do a poem from the trading. My good friend Frank, who's a trading poet, always writes great poems, always pertinent to what's going on. And then after that, I have gone down through my master watch list, both on the daily and the weekly time frames. I have identified some potential trades that I will be looking at next week. Both on the daily and the weekly. Of course, the dailies are dailies. Weeklies, I will wait until next Friday to make my decisions. Generally, in trading, at least the way that I trade, I need a market to go down, reject some kind of support to show me that there's some kind of support there, or it needs to go higher, showing me that there's some upward momentum. So generally, right at the time when I look at these charts, there are no trades, but that's why I do this podcast, because I want to share with you how I think about trading and the levels that I'm looking for. So I have some good ones, both on the daily and the weekly, and excited to share those with you as well. Okay, so that's the plan for today. First of all, I am going to run the U.S. legal disclaimer. I will be back in about 40 seconds, so hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me, and let's get started. I trade 5 different type of approaches in my trading. I trade deep dip buys, I trade return to value V1s, V2s, I trade higher low V1s, V2s, I trade moving average crossovers and double bottoms and bullish divergences. So what I'm going to show you here today on my trades, all the trades are going to be one of those 5. And just wanted to let everyone know that, in this podcast, I do my best to show you what the signals are and how I'm going to manage them. But I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course. I teach you step by step how to trade all of the 5 different approaches that I use. And the process that I use. And if you are interested, I think it would be time well spent and money well spent. I really like to teach. I've taught people from all over the world, and I don't think I've ever had a student that has not been happy with the results of the teaching. So My email is in the link of this YouTube video. All you have to do is reach out to me, and we'll get a conversation going. But I think it's money well spent, and I think you'll enjoy the results. And I'll talk a little bit more about this as we get closer to the end of the podcast. Let's start out with VIX. Boy, VIX has been a great trade. I did take a long position in VIX back on the 2nd of February, and the main signal that got me into this long position was a under 30 over 30 RSI back on the 2nd. That's the main signal. Now, there's some contributing factors to this signal as well. Negative third ATR channel down here. 92% of prices tend to stop going down or go up when we get to this level. So again, the main signal, we went under 30 during the day, back over 30. That's the main signal. The contributing factors that make this trade even better were a rejection of the negative third ATR channel and a V1 entry signal. V1s consist of two bars. Bar 1, bar 2 goes below bar 1's low and then closes above bar 1's close. Now, I'm not going to take the trade just based on the V1. I'm not going to take the trade just based on the rejection of the negative third ATR channel. The main signal is the intraday under 30 over 30. But in combination, this is what makes the trade a stronger trade because of the rejection of the negative third ATR channel and the V1. And if you've been listening to this podcast for any length of time, you know that one of the most important things that I look for in my trading is a combination or a confluences of different signals lining up. In other words, in my lessons, I teach my students this, that the more signals you have, really what that means is the more buyers are coming in. And the more buyers that are coming in, the better the chance that you're going to have a profitable trade. Okay, so I did get long VIX at 11.17 back on the 2nd. Now, as it moves up, here's the day that I bought it at 11.17. What I do is I take the closing price of the day, I add the value of the 0.45 ATR to it. In this case, it's 25 cents. And so I take the closing price, I add the value of the 0.45 to that. That gives me the first profit target for the next day. I take the first profit target, I add the 0.45 value to it again. That gives me the second, and then I take the second and I add it on, gives me the third. Now, in all of my trades, when I first get into a trade, I guess I should have said this first, but the main thing that I do when I get into the trade is that I have to decide how many shares that I'm going to buy. And this is a really good formula that takes into consideration the volatility of the market. And if the bars are going really up and really down and really up and really down, then that means the volatility is higher and you need to buy fewer shares. If they're not, if the volatility is lower, then you're going to buy more shares, So let's just get started here, because this is the same on any particular trade. What I do to determine how many shares I'm going to buy, I take the value of my total account. Let's just say it's $100,000. I like to take 1% of my total capital. So 1% of $100,000 is $1,000. And then I divide that by the value of the 2 ATR, in this case 109, divided by 109. That tells me to buy 917 shares. Okay, if you had $1 million in your account, 1% would be 10,000, right? If you had $50,000, 1% would be 500. So it's the same. You just take your 1% of your total account, and I divide it by the value of the 2 ATR. That shows me how many shares to buy based upon the market volatility. Now, as soon as I buy that, I have to put my emergency stop exactly 2 ATRs below my entry, so that if it does come down there, then I'm going to go ahead and get out of the trade. And how much would I lose? Well, I'd lose $1,000. Now, does that mean I'm risking $1,000 on every trade? It does, but in reality, I'm not going to lose $1,000 on every trade, because my end of day stop is going to come in. Remember, the emergency stop is the worst case scenario. And I base my entries and exits on the closing price. I buy or sell right before the market closes. And so the under 30 over 30 is why I took the trade. Therefore, if it had closed back under 30, I would simply get out. But I have the emergency stop down here just in case. And if it does hit my emergency stop, I don't wait for the end of the day or the end of the week because I've hit my maximum allowed loss on any one trade there. So looking for the entry, under 30, over 30, rejection of the negative third ATR channel and the V1. I position size, I place my emergency stops 2 ATRs below. If it gets there, regardless of where we are during the day or the week, I get out because that's the maximum allowed loss I'm willing to have on any one trade. But the reason I took the trade, the under 30, over 30, if it closes back below 30 RSI, then I'm going to get out. And about 95% of the time, your end of day stop or your end of bar stop is going to come into play, not your emergency stop. 5% of the time, you are going to hit that emergency stop, and it happens. So that's the entry, emergency stop, end of day stop. That's defensive. Taking partial profits based upon the 0.45 ATR value, 10% of whatever I have. If it hits the first profit target, I take off 10% of the position I have. If I hits another target, I take another 10% off. So in other words, as it moves up, I'm going to take partial profits. So I bought it here 11.17. Next day moved up, hit a profit target, took 10% off. Next day, no profit target. Next day, no profit target. Next day here, I hit 2 profit targets. And then on Friday, hit another profit target. So I like to play offense and defense. If it goes down, I have my emergency stops in place. I have my end of day stops in place. As it moves up, I take partial profits. And so I had some nice partial profits here. Now on Friday, one of my trailing stop rules came into place because if I take an under 30 over 30 RSI and it moves up like it did, if it rejects the 50 RSI, that's kind of a key level to tell me this may be coming back down. So I sold half on Friday because it rejected. Right now we're at a 49 RSI, but we were much higher. So we were above 50 and we closed below 50. So that's a rejection of the 50 RSI to the upside. That's a bit of a warning sign, and that's why I decided to lock in half of the position. And I locked in half the position for a profit of 8.29%. Now, orange line up here, this is my trailing stop level. If I get once I enter, I place 1.5 ATRs above. You can see 1.5 ATRs, 0.82. If it gets there, then I go into trailing stop mode. Trailing stop mode means that if I get to trailing stop mode and then I have a close below a previous bar's low, then I will get out of the other half of the position. So under 30, over 30s, there's 3 rules. If you get to trailing stop level and then you have a close below a previous bar's low, you get out. If you reject the 50 SMA, you get out of half. If you reject the 50 RSI, you get out of half. And if 2 of the 3 happen, you are totally out of the trade. So the first one happened on Friday with rejection of the 50 RSI. Now, Tuesday, because Monday we're off, Tuesday, if I close below a previous bar's low, then I will be out of the trade completely. And I like taking half profits because it's one of the only win-win situations in trading. Because if I took half profits here on Friday. If it continues up, I'm still happy because I have half. If it goes down, I'm happy that I sold half. So it's one of the only win-win situations in trading. And so anyway, here we are on VIX. Under 30, over 30, V1 rejection of the negative third ATR channel. That's the entry. Place my emergency stop. My end of day stop is the opposite of why I got into the trade, the under 30, over 30. We got to trailing stop level, looking for a close below the previous bar's low to get out of half. Friday, rejection of the 50 RSI. Got out of half for a profit of 8.29%. Next week, if we have a close below previous bar's low, I'll be out of the entire position. So nice trade here on VIX. Next on deck is UNG, natural gas. Why did I take the trade? Well, took the trade with an under 30, over 30 RSI. Also a V2. A V2 consists of 3 bars. Bar 1, bar 2 goes below, bar 1's low, bar 3 closes above bar 1's close. So we have under 30, over 30, V2, and rejection of the negative third ATR channel. We close back above it. Where's my end of day stop? Closed below 30 RSI. Moved up, took a little profits with profit targeting that I just discussed with you. Then we came back down, got close to closing back under the 30 RSI, but it didn't. It held. That's a key level. The 30 RSI also reject the negative third ATR channel. Next day we went up. Friday we went up as well. And you can see when I entered, I placed my emergency stop down here. My end of day stops closed below the 30 RSI. Place my trailing stop level up here. Haven't got there yet, but once we do, get into trailing stop mode. And this particular trade, up 3.75. And by the way, I'm talking about V1s, V2s. Of course, I teach these in my one-on-one lessons, but I do have a free video in my YouTube channel under the lessons playlist called V1 and V2 entries. It's totally free. I think it'll be helpful for you. V1s, V2s, I use them all the time in my trading, and I think they'll be helpful for you. So check out that link, and I believe I also have it in the link of this YouTube video as well. So under 30, over 30, V2, rejection of the negative third ATR channel. Emergency stop down here, end of day stop, close below 30 RSI, which did not happen. Emergency stop here, took profits here, took profits there, took profits there. This particular trade up 3.75%. You know, one thing I also wanted to note is natural gas, UNG, had come down so much. It was just one of those trains that just kept going down and down and down. Whenever you see that, whenever you see an extended move down and then you see a lot of volume starting to come in, that's kind of an indication that you may be near a bottom, because a lot of people are buying, but yet a lot of people are selling as well. And just in my 28 years of experience, that's what I have noticed. And you can see the volume did pick up dramatically down here in these lower areas. And that's one of the things that made me interested in getting long this. So anyway, this particular trade up 3.75% in the last week. So very grateful for that. All right, here we go. Pfizer, another deep dip buy. I bought Pfizer back here on the 7th of February. Why did I buy it? Well, it was a higher low, under 30, over 30. You know, if you've listened to this podcast for a while, or if you're one of my students, you'll know I like higher low things better than anything lower low. This right here wasn't under 30, over 30, but it came from a lower position, and lower position under 30, over 30s tend to bounce like this one did and then come back. A higher low under 30, and this the day that I bought this here, it went under 30 and then closed over 30. But you see how this low is higher than this low? That's a higher low under 30, over 30. And that is why I bought that, because higher lows, whether they're V1s, V2s, rejections of the 200-day moving averages, they tend to give easier long legs up. And I guess you just have to believe me on that one, but I've been doing this for a long time. But it's a dramatic difference. Anything higher low is better than lower low. But here was the trade. It went under 30, over 30. That was my entry signal. I placed my emergency stop 2 ATRs below. My end of day stop is just simply a close below the 30 RSI. Thursday, it almost got there. Went down again, but closed above, kept me in the trade. MACD is green. That's also a benefit to this trade. And emergency stop down here, right? Trailing stop level up here. Haven't got there yet, but this particular trade in the money, 0.93% so far. So glad for that. CCJ. Okay, CCJ, this is a short trade. And why did I take this trade? Well, this is a double top with a bearish divergence. Again, this is something that I teach in my one-on-one course. I learned this from studying one-on-one with Dr. Alexander Elder. And here we have a high, and I look at the MACD bars here. These are momentum indicators that's showing strong momentum to the upside because of the green bars. Then we pulled back. We went red on the MACD, or in other words, the momentum went negative, then we've come back up. We've made a higher high than this high. But during this high, look how high the MACD bars are. Thursday, we made another high, but there's no green bars whatsoever. I shorted on Friday here because of the double top. The first top, lots of green bars. The second top, no green bars whatsoever. That's showing that there's a lack of momentum on this move up. And the implication of a lack of buying momentum is that you're going to head back down. So I really like the double top here with the bearish divergence. We also have an RSI divergence. Look at the top here. Look at the RSI level up here, way above the 70 RSI. Well, Friday, we went above 70 and below 70. That was the reason for the exit. But look at the RSI down here. You see how it's lower than over here? So it's confirming the MACD divergence with the RSI divergence. Now, this doesn't mean this is going to come crashing down, but it's a very good risk to reward ratio. What was the main reason I got into the trade? Well, because on Friday it went above 70 and then below 70. 70 RSI is a key level of resistance to the upside. So I entered short 29.28. I took my maximum allowed loss. I divided by the value of the 2 ATR. That shows me how many shares to buy. I take the 2 ATR, add it above because this is a short entry, and that will be my maximum allowed loss. So in the hypothetical $100,000 account, if it does get up here to 31.21, which is 2 ATRs above my entry, that's my maximum allowed loss. I'll lose a hypothetical $1,000. However, my end of day stop, because I'm short, is simply if it closes above the 70 RSI. If it closes above the 70 RSI, I'm just out, take a small loss, and that's it. Orange line, 1.5 ATR trailing stop level to the downside. If it comes down, then once it gets there, I'll go into trailing stop level, meaning that if I have a close above a previous bar's high, then I will get out of half. Okay, so double top, bearish divergence, MACD bearish, MACD divergence, bearish RSI divergence, rejection of the 70 RSI was my entry. End of day stop, close above the 70 RSI, emergency stop up here as always. And then in this case, if it moves down, I will take partial profits. Here's the closing price, 29.21. What I'll do is I'll take 29.21, I'll minus the value of the 0.45, which is 0.45. So if it moves 0.45 ATRs or 0.45 below my entry short point, I will take off 10%. If it moves another 0.45, I'll take off another 10% and lock in those profits as it is moving my way. So good example here of a double top, bearish divergence, RSI divergence, MACD divergence, and I like having some short positions here as well. And again, all of these things that I'm talking about here, that is what I teach in my one-on-one course, and I will teach you step by step how to do this. So, okay, I guess, just so I can do my stuff on Twitter, this is in the money, 0.24%. Got that right before the market closed, so good for that. Okay, I think that's all on our daily trades. Here we go. Let's get to the weekly trades. Again, weekly trades, I set up exactly the same way. Emergency stop, end of week stock, profit targets, all that kind of stuff. And I did get short QLD, which is double leveraged QQQ last week on Friday, and I got short at 46.10. Why did I get short? Well, we rejected the 200-week moving average above. This is the main signal of why I got short. So I position sized my emergency stops 2 ATRs above. My end of week stop, because this is a weekly trade, is simply going to be a close above the 200. So emergency stop up here, 2 ATRs below. End of week stop, just to close above the 200 SMA. Here's my trailing stop level below. And you can see the average true range, the 0.45 average true range is $1.95. So last week I got short at 46.10. Of course, 2 weeks ago. Last week it did move down, moved my way, did take some profits off, right? And that's why I like taking partial profit. If this goes zooming up next week, well, that's going to be unfortunate for the short trade, but at least I locked in a portion of the profits down here while it was going my way. So that's the reason for the trade. This particular trade is in the money, 5.47%. So very, very happy with that. SSO, long position that I took in SSO all the way back here on the 6th of January. Why did I take it? This is a deep dip buy. I took it with a close below the 200, close back above the 200. I position size, I place my 2 ATR emergency stop below my entry. My end of week stop, well, why did I get into the trade? Because it went under 200, over 200. Therefore, my end of week stop is just going to simply be a close below the 200. The next week, it came down, tested the 200, closed back above. Next week, tested, closed back above, kept me in the trade. The first week after my entry, took off 10% of my profits there. From here to here, took another 10% off. From here to here, took another 10% off. That's the offensive part. And you can see 1.5 ATR trailing stop level above. That's my trailing stop level. Did get there. Doesn't mean I do anything. But as soon as I get there, if I get a close below a previous bar's low, I will get out of half of the position. Now, if I get up to the 65 RSI level up here, then the 5 EMA will come into play. And if I have a close below the 5 EMA, then I'll get out of the entire position. Alternatively, if we reject the 70 RSI on the weekly, then I will get out of half of my position. And then if we reject the 70 RSI level, and then after that, if I have a close below the previous bar's low, then I will get out of the entire position. And that's what I was talking about before. Most of my career I have spent looking for processes of how to maximize gains, reduce drawdowns. And that's to me, that's the difference between a profitable trader and an unprofitable trader. So this last week we had an inside bar here. If I have next Friday, if I have a close below the previous bar's low, I will get out of half, but been taking profits all the way up. This has been a really good trade so far. This is double leverage. So far, this particular trade up 9.12%. IWM, I have been in this trade forever. I got in this trade back on the 14th of October. Why did I get in? Well, look, here's the 300-day moving average. We went below it, closed above it. I placed my emergency stop down here. My end-of-day stop would have simply been a weekly close below the 300. Never happened. As it moved up, took profits 2 weeks after I took the entry, got to trailing stop level. Doesn't mean I do anything, but it means that I now go into trailing stop mode. Continued up, took more profits, and then this was the first bar that closed below the previous bar's low. Got out of half here at 178.70, got in 167.19. After I got out of half, we went back down. I was like, oh, I'm glad I got out of half up there. But then we came down and had another huge move up as we've moved up, taking profits. Took a lot of profits 2 weeks ago here. I've already used my trailing stop level rejection area here, so that does not come into place again. Really, all I'm waiting for in IWM is to get to the 65 RSI level, and if we do get to the 65 RSI level, then a close below the 5 EMA makes more sense. If it keeps going up, reject the 70, I'll get out of half. If it does reject the 70 and then have a close below previous bar's low, I will be out of the trade. Alternatively, my end-of-day stop here at this point is still the 300-day moving average. And so I've been in this trade a long time. It's been a great return by taking this trade, just giving it some room here, some breathing room. This particular trade on the remaining shares, up 12.127%. KMX. All right, this is a little different trade here. Again, this is what I teach in my private one-on-one lessons. This is a higher low V1, higher low V1. Well, I guess I should mention this. See the green line here? See the green line here? You see this channel? This is called the value zone. If I close below the value zone, come into the value zone, and then have a pullback and have a V1 or a V2 entry, that is why I took the trade. So I took the trade here with this V1. See, here's bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That's the entry. Of course, I position size. I placed my emergency stop 2 ATRs below. Now, this is not a deep dip buy. We don't have a 200 or 250 or 300 or 30 RSI coming into play here. So I have to have another end of day stop. Well, my end of day stop is simply a close below the washout bar that triggered the V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above. You can see the little purple line here. This is halfway of this bar. My end of week stop on this would simply been a close below that. Emergency stop down here, but any close below halfway here, I'm simply out of the trade, giving me a very, very good risk to reward ratio. And this has been a great trade. Next week moved up, took 10% profits. The week after that, huge move up. I believe I hit 3 profit targets into this strength, right? Took those, banked those. Market can't take that away. Last week, we did get, or 2 weeks ago, we did get to the 1.5 ATR trailing stop level. So now I am in trailing stop mode. I'm just looking for a close below a previous bar's low to get out of half. Last week was down, but did not close below this low. Next week, if we close below this week's low, I would get out of half for sure. And another rule is if I take a higher low V1 and it moves 1.5 ATR trailing stop level, which it did, then if it ever gets back to my entry point, I'm just out. Now, would I be even? No. I have been taking profits on the way up. So really, I shouldn't say there's no way, but it's very unlikely this trade will not be profitable for me because I've taken profits the week after. The week after, I took 3 profit targets, basically out of 40% of this trade at profitable levels. And again, it's just a rule with a higher low V1 or V2. If I move 1.5 ATR trailing stop level and then get back to even, I'm just going to get out because, this trade, let's take a look. This particular trade on the remaining shares that I have, up 10.8%. So it's been a great trade. I love higher low V1s and V2s, higher low anything, like I mentioned earlier in the podcast, 10-2 trend, and this is exactly what it did. So very happy with the 10.8% gain on KMX. WBA, all right, every single trade has been profitable except for this one, but this one is only slightly down. Why did I take this trade? This is a great example of a return to value V1 or V2. Again, what I teach in my private one-on-one lessons. The rules for a return to value V1 or 2 are as follows. First of all, the price has to close above the 1 ATR channel. To me, this shows that we're in a bit of an uptrend. And it did here, stayed here, stayed here. Then we came back down into the value zone. The value zone is between this green line and this green line. We moved down, we kept moving down, we kept moving down. Then we had 2 days of sideways motion. Sideways motion is very important. We need to know that there are buyers coming in as to counteract the sellers that are coming in, show that there is some support. Well, here's your 2 days sideways to this bar, and then we triggered the V2. Here is bar 1. Bar 2 goes below bar 1's low, closes above bar 1's close. That's the entry point. Position size, emergency stop. Now remember on V1s, V2s, a close below halfway the washout bar is your end of week stop. Well, here it is at 36.10. Bought it here at 36.90. Next week came down. Look how it tested that halfway, bounced up. Last week tested halfway, closed back up. If this week would have closed below this line, I would have simply gotten out. But the market does, on V1s and V2s, it does tend to come back and test those levels before it moves up. Will it move up? I don't know. I sure hope so. But if it doesn't next week and we close below this 36.10, then I'm just out. In the worst case scenario, if it gets down to my 2 ATR emergency stop, I will just get out. This trade slightly down from entry to current price, down 0.96%. Let's see, is that it? I think that's it as far as the current trades. All right, so let's talk a little bit about trader psychology. This is from my good friend Thomas Paine. Thomas Paine, I really respect this gentleman. He was a scientist, that was his career path, and he did a pivot and decided to become a trader, but he took everything he learned about the scientific method and started using that, implementing that in his trading. Please follow Thomas. You'll be glad you did at Trader T Pain over on Twitter. Let's see what Thomas has to say today. Sometimes a good stock setup will hit a well-placed stop loss and shake you out. That is okay. But if the stock sets itself up again, you need to view it as a new trade and not take the previous loss personal. A good setup is a good setup regardless if you got burnt the last time. And I teach my students this all the time because I see this happen all the time. Even with a great setup, position size, emergency stop, end of day stop, and it's important to be patient and wait for those setups, but they're not always going to work. But so if you take a trade, it looks perfect, you have all these combinations, you have all these confluences of signals, and it doesn't work, well, if it sets up again, don't be afraid to take it again. Some of my biggest trades have been from one setup failing, taking it again, it failing, and then the next one being a big trade. And it's kind of human nature that if you lose money, especially on the same stock for some reason, if you lose money, if you take a setup on, IBM and it fails, and then you take a setup again on IBM and it fails, you're like, and then you have another setup, you're like, oh, do I want to give more money to IBM? You'd almost rather just take another stock because it's, adding insult to injury for that same stock. But if you have a proper setup and you've had proper setups in the past that have failed, do not be afraid to take it again. Really, honestly. Sometimes a good stock setup will hit a well-placed stop loss and shake you out. Yes, that's true. It happens. That is okay. But if the stock sets itself up again, and it has to be a valid signal, right? Not just any signal. It just has to be a valid signal again. You need to view it as a new trade and not take the previous loss personal. That's very well said, not taking the previous loss personal. A good setup is a good setup regardless if you got burnt the last time. So remember that. Some of my best trades have come from getting into a trade that previously I had a setup that failed and then had another setup that failed. And don't let that dissuade you from taking the new setup, especially if it's in the same stock. So thank you, Thomas. Good advice. Please follow Thomas over at Trader T Pain. Okay, before we get to potential trades for next week, just quickly want to do a poem for my friend Frank. You can follow Frank at FrancoD over on Twitter. Today's market poem. We've all made mistakes trading, and now we have learned. What good is anything if you get burned? Experience comes from each trade that we turn. Focus and practice on the methods that help us earn. Isn't that great? Focus and practice on the methods that help us earn. What does that mean? That means having a process. That means position sizing, knowing where your stops are, knowing where significant overhead resistance levels are. In my case, taking partial profits on the way up. That's my process. So let's read it one more time. We've all made mistakes trading and now have learned. What good is anything if you get burned? Experience comes from each trade that we turn. Focus and practice on the methods that help us earn. Thank you, Frank. Appreciate that, my friend. All right. Let's take a look. I am looking, like I said, I went through my master watch list and I've identified some weekly trades and some daily trades that I'm interested in for next week. Whatever these signals are that I'm going to teach you or that I'm going to mention here are going to be one of the 5 trading approaches and strategies that I use. One of the things that I really like to look for in my setups is, of course, a good setup on the time frame that I'm taking the trade on, but also looking at the higher time frame to see if there is some support as well. And again, these are the things that I teach in my one-on-one lessons. But what I've done is I've identified on the dailies the levels that I'm looking for to enter the trade, and then I'll also show you. So on Apple here, of course, just a pullback to the 200 would make sense because they're most likely will be buyers that come in with this 200, not certain, but a lot of times there are. So I mark the 200 level here, and then on the weekly, you can see what the 200 level on the daily lines up with on the weekly to see if there's some support as well. Hope that makes sense. So on Apple, 200-day moving average here. This would make a lot of sense. We had a huge move up. Having a pullback also makes sense here. People are taking some profits, but the 200 would be a great place for new buyers to come in for a resumption of the uptrend. So the 200-day moving average next week, I'm looking for a rejection of the 200-day moving average. In other words, it goes down below during the day and then closes back up, gives me a good risk to reward ratio. Or alternatively, it could close below the 200 and then close back above the 200. But again, as I just mentioned, this level here of the 200, I drew the green line. If we go over to the weekly, let's take a look and see, does that green line line up with any support? It does. See the little dotted line here? That's the 50 EMA. Almost dovetails perfectly. So there should be some buyers that will come in at this moving average on the weekly, and that will dovetail nicely with the 200 on the daily. So it's very important to look at multiple time frames in your trading. So for Apple next week, if and only if it does go back down, reject the 200, I will get long Apple. AMD, same kind of pattern, same kind of configuration, big, strong up bars. Market got a little ahead of itself. Now we've pulled back and back and back and back and back. A rejection next week of this 200 SMA would make a lot of sense. I drew the line here. Let's go to the higher time frame, see if there's some support. You might go, Greg, I don't see any support. It's not the 5 EMA, it's not the 1 ATR channel, but there is support. See this big bar, the big up bar? Well, whenever you have a big up bar, if you come back down, and it quite often it will happen, if you come back down to about halfway of this bar, there are some inherent support levels there from the Fibonacci standpoint. So again, the line here, very close to the halfway. We went up this high, come back down to about the halfway. That halfway dovetails nicely on the trading time frame, on the daily, the shorter time frame of the 200. So with the support of the 200 on the daily being very close to halfway of the big up bar on the weekly, that would be multiple time frame confluences of support. So on the weekly, big up bar. If we come back down to halfway, that dovetails on the daily with the 200. So to have a rejection of the 200 next week on AMD, or a close under, close over, that could get me positive. Now, a lot of these trades look similar. It doesn't mean if all of them trigger, I'm going to take all of them. I'll just have to look at it in the larger context and see which one has the most confluences of signals. Alibaba, well, look at Alibaba. My gosh, you guys glad that you didn't buy up here? So my first level of interest on Alibaba is here at the 300 SMA. 300 SMA is a deep dip buy strategy. This is what I teach in my private one-on-one lessons. But so I drew the line here, let's see, right about there. And let's pop over to the weekly and see what the 300 on the weekly looks like on the daily. Look, see the big bar up? Right about halfway. This was a big move up. This pullback does not surprise me, but looking for halfway of this big up bar, which dovetails with the 300, that would be able to let me set up the trade. My 300 would be the line in the sand. So a intraday rejection of the 300 next week would get me long. Alternatively, a close under, close over would get me long. And again, that level dovetails on the weekly at about halfway of that big up bar, which should provide support on the weekly as well. FCX, all right, Freeport, McMorgan, copper, and gold. Well, I mentioned a return to value V1, V2, one of my favorite trades, and this one qualifies. Look, here's the 1 ATR channel, here's the negative 1 ATR channel. We move above, we come back down into the value zone. We need some sideways motion Here's the sideways motion. And this trade is for Monday only. This is setting up and formatting as a potential return to value V2. Wednesday, bar 1. Or Thursday, bar 1. Friday, we go below bar 1's low. So it's not a V1, but it's setting up for a potential V2 on Monday, but only on Monday. If on Monday we get above bar 1's close here at 42.94, that will be the return to value V2. Then I'll position size, I'll place my emergency stop 2 ATR below. Where will my end of day stop be? Well, if this triggers a V2 on Monday, then it would be halfway of the washout bar. I place my 1.5 trailing ATR stop level above my trailing stop level. And if it moves up, as it moves up, I'll take partial profits. So again, just want to reiterate for myself that this particular trade is only valid if Monday we get above 42.94. Gold. Well, gold has really sold off here, but I think it's giving us an opportunity for another deep dip buy. And let's take a look. Well, I have this all the way down here at 168.70. Why? Well, look, here's a confluence of the 300 SMA and the 250 SMA. Very good chance that some buyers will come in at that level. And at the very least, it gives me a good risk reward ratio and gives me a good line in the sand to construct and design my trade from. Here at 167.70. So the 250 and the 300, let's go over to the larger time frame and see what that dovetails with. Ooh, pretty nice. So the daily 250, the daily 250 and 300 level here at 168.70 on the weekly dovetails nicely with this band of moving averages on the weekly, the 100, the 50, very good spot, and that would make sense that after this big move up, you'd have a pullback. So on the weekly, the 50, the 100, nice confluence of support levels here on the weekly. On the daily, the entry point would be some kind of rejection, intraday rejection of the 300 and the 250, or also a close under, close over. So really like this, makes sense after a big move up, a pullback. And of course, we don't know if it's ever going to work, but at least it gives us a very good risk to reward ratio with the same time the weekly making sense on support levels as well. MasterCard. Okay, well, this is quite a beautiful example of a return to value V1, V2. Price levels above the 1 ATR channel come back into the value zone. Sideways motion, sideways motion, sideways motion, sideways motion. This is setting up for a beautiful and perfect return to value V2 if and only if it happens on Monday. Bar 1. Bar 2 goes below bar 1's low. If bar 3 goes above bar 1's close, or in other words, it closes above 370.42, I will get long MasterCard. This is a beautiful signal. It doesn't mean it has to work, but this is a picture perfect return to value potential V2, but only if it happens on Monday. Microsoft, all right. Well, Microsoft has had a huge move up here. Of course, the 200-day moving average jumps right out at me here. Drew the line here. Let's see what that looks like on the weekly chart. Well, again, it dovetails with halfway of this big bar up on the weekly. So again, on the daily, the 200 is the level that I'm looking for. On the higher time frame on the weekly, dovetails nicely with about halfway of this big bar. So we have a confluence both on the daily and the weekly. I look at the weekly kind of as does it have some kind of level of support based upon the entry point that I'm looking for on the daily? And yes, it definitely does. Silver. Well, silver has really gone down quite a bit. Right now we are at a 35.87. Well, an under 30 over 30 would be the move for me. Doesn't mean it's going to go down there, but if it does, we're at 35.87. Next week, if we go below 30 and then close back above, whether it's intraday or just bar to bar, that would get me interested. Of course, the 200 down here would also give me interested. Would make sense that some buyers would come in there. But the 30 RSI next week would be roughly at 1979. Let's take a look at the weekly and see where that, if that level dovetails with anything. It does. Look at that, everyone. Dovetails beautifully with the 200 week. That's a strong level. So on the weekly, if we get down to 1979, that will be the 200. There will probably be some weekly buyers that are coming in there. And then there will probably also be some buyers with the under 30 over 30. So I'm looking for next week something around 1979. It depends how long it takes to get down there, if it gets down there. But that would be the entry. Intraday rejection of the 30 RSI anytime next week would get me long, or alternatively rejection of the 200-day moving average. But again, on the weekly, it dovetails beautifully with the 200 week. And again, these are everything that I teach in my lessons. You know, I know there's a lot of rules here, a lot of different things. If you're kind of scratching your head and going, man, how does he keep this all straight? Well, that's what I would teach you in my one-on-one course. All right, last but not least, XLRE, which is the real estate sector. Well, had a nice move off the low with the rest of the market. Look, we are below the 200-day moving average at this point. If we have a close above the 200, that gives me a very good risk-to-reward ratio. Let's look over at the weekly. I already like the weekly a lot. Do you see how the weekly came down, tested the 200 week, and then closed back above it? That's an important on the larger time frame. That shows that there were no more sellers below this level. Now, does it mean that I'm going to just jump in? No, it doesn't. But if we have a close over the 200-day moving average, for one, that's just a good entry point anyway. As long as it, if it closed up here, I probably would pass on the trade because the risk to reward ratio wouldn't be. But if we had a nice gentle close above the 200, it gives me a very good risk to reward ratio. And in addition to that, looking at the higher time frame on the weekly, it already rejected the 200. So next week, if we get a nice gentle close above the 200-day moving average on the daily, based upon where the weekly is rejecting the 200, then I would get long XLRE. Okay, so those are the dailies. Let's switch to the weeklies. And again, weekly bars close on Friday. So anything that I'm showing you here on the weekly bars, I will make my decision on that based next Friday. Okay, now if we're trading the weekly bars, what's the higher time frame? The monthly. So on the dailies, I showed you the weeklies. On the weeklies, I'm going to show you the monthlies. Make sense? Hope that makes sense. All right, so Nike had a nice move up, would have been a nice trade over the 200. Look, good risk reward ratio all the way up. But I'm looking for a pullback to the 200 week moving average. That would make sense. Any big strong up move like this, yes, it's quite normal to have a pullback, totally normal. But if we came back, there's a lot of support here. There's the 50-week moving EMA average, there's the 200-week, there's the 1 ATR channel, there's the 20. Lot of support in this level. And if it does come back, have an intraday rejection of that 200-week moving average, I will buy it. Now, I drew the line here at the 200. Let's see how that dovetails on the monthly. Well, dovetails nicely with the 10 monthly EMA and the 5 monthly EMA. So I'm hoping this is making sense of using support on both time frames. The larger time frame here is the monthly, and I drew the line on the weekly, which is the 200. That dovetails on the monthly at the 10 and the 5. On the weekly, on the tradable time frame, dovetails with the 200. So I really like this. I hope it gets down here. I would like to get into Nike because of this really great confluence of indicators both on the weekly and the monthly. So again, any kind of rejection of the 200 with a good risk to reward ratio, I will take next week, next Friday, or if it closes under and then closes back over the following week, I would get in depending on the risk to reward ratio. Silver, okay. Again, 200, we've had this nice move up in silver. A pullback makes sense to the 200-week moving average. I drew the line here. Let's see where that dovetails on the monthly. On the monthly, dovetails with the monthly 50 EMA. And a nice gap here as well, a nice fair value gap as well. So if and only if next week on SLV we get to rejection of the 200-week moving average, I will get long SLV. Tesla, my goodness, what a trade. What a trade. Look at this beautiful trade. Under 300, over 300, you'd have almost doubled your money on that trade if you would have taken that trade. I actually did take Tesla. I can't remember now if I bought it on the weekly or on the daily, but I had a really good trade. I think it was in the 20% levels or larger. But what am I looking for now on Tesla? Well, we've had this big move up. We've come well off of the highs. I wouldn't be surprised if we had a pullback to the 200-week moving average. But only if it gets there. I drew the line. Let's take a look at the monthly, see what that dovetails with. Yeah, that dovetails nicely with the 50-month, pretty close to the 50-month moving average. So multiple support on multiple time frames. Doesn't mean it has to get back to the 200, but if it does, I will get there based upon it having a pullback to the 200 where it should find some support, and then also based upon the level on the monthly of the 50 support below. All right, XLU. Well, XLU, utility sector, 200 would make a lot of sense. I don't know if it's going to get down here, but if it does, it would be a higher low rejection of the 200. This is a lower low here. That would make a lot of sense. Drew the line here at 64.50. Let's take a look at the monthly. Monthly, can you see any support? Well, I can. Look at the bar here. Big up bar. Would make sense. It would come back down. See how it's halfway? That should act as some support. So almost exactly halfway on the monthly. That Fibonacci point there, drawing the line on the shorter time frame, dovetails perfectly with the 200. So any kind of next Friday intraday or intra-week rejection of the 200 would get me long. So what I want to do is I want to talk a little bit just about the indexes and the market in general. Let's take a look. And I also want to talk about the dollar. I want to talk about bonds. I want to talk about VIX as well, just taking a big picture look because they all influence each other. Let's start with the Qs. Well, Qs, obvious point would be the 200-day moving average. We've had a big move up, obviously, in the market. We've had a pullback based upon some statements from the Fed. People are thinking they're going to pivot. They think interest rates are maybe slowing, so forth. So this big move up here totally makes sense that we would have a pullback. But on the Qs, I would not be surprised to see us pull back at least into the value zone a little bit here. On SPY, a little bit stronger than the Qs here, moved up, level here at the 250, possibly down here at the 200. Diamonds, which is the Dow, not participated in the rally as much as the Qs and the SPY, but back in the value zone, wouldn't be surprised to see a move up. IWM, probably the weakest, had a nice move up, pull back into the value zone. This would make sense here as far as a level where new buyers would come in to resume the upward trend. Let's look at the dollar. Now, the dollar really has moved up, and generally, if the dollar moves up, that's generally bad for the market, okay? But what I'm looking for here on the dollar, see this big down bar, huge down bar? Well, if you have a huge down bar and you rally back to halfway, then it's most likely, not most likely, but there's a good chance that that's going to be it and it's going to come back down. So if we're looking as a rally in the dollar as negative for the market, you know, maybe we go down a little bit more next week, but I have a feeling if the dollar gets to halfway of this big down bar, then that will be about it for the dollar, and it will come back down, and most likely the market will go back up. just an opinion, doesn't mean it has to happen, but looking at the technicals, if we have a little bit more move up on the dollar, then I have a feeling that's going to be about it, and most likely, or there's a good chance that it will come back down and the market will go back up. TLT, bonds. Well, as bonds come down, that's the interest rates are higher. And so the market's going to do better if the bond market moves up. Well, there's a nice level of support here on TLT of the negative third ATR channel and the 100. Let's take a look at the weekly and see where that dovetails halfway of this big up bar here. So I could see bonds coming down a little bit more, or in other words, interest rates going up a little bit higher, which would be bearish for the market. But we're getting to these levels where I think, based upon TLT, based upon the dollar, yes, they've rallied, which is bad for the market, but they are coming into levels where I think they are going to reject or support or reject on the dollar. If it rejected here and came back down, that would be bullish for stocks. Bonds, if we start to go, if it looks like there's a level here, if it starts to rally, that would be bullish for bonds, which would be bullish for stocks. And then the VIX, of course, which is the volatility index, it's moved up higher and the market's moved lower. But as you know from the trade that I discussed at the beginning of the podcast, there was a rejection of 50 RSI, and that's why I took half the profit. But if it comes back down, that's going to be bullish for stocks. So basically what I'm saying is, we had a big up move in the market. We had bonds, we had VIX, we had dollar go against us, but all of those are either finding support or finding resistance level, which indicates to me probably that the market is near a short-term low on this pullback and will rally. So, at the beginning of the podcast, I mentioned that I do teach private one-on-one lessons in the evening time via Skype. I think the best way to learn anything, whether it's guitar or violin or pickleball or trading, is one-on-one with an experienced mentor or coach. And, people take these lessons in a class format. That's great. Sometimes people are scared to ask questions or they're embarrassed, but that is why I set up my one-on-one lessons one-on-one, because I just think it's the best way to learn. So if you are interested in learning step-by-step how I trade, you can do that. All you have to do is email me, say, Greg, I'm potentially interested in taking your 15-hour one-on-one course. I will reply and say, hey, great. Thank you so much for reaching out. What I like to do with the potential student is I like to have an initial Skype call with them. It is a free call. It is not a sales call. I just want to get to know you a little bit better, learn more about you, your trading challenges, your goals, and it's also a great time for you to ask me any specific questions about the format and the syllabus of the course. And then when we're done with the call, then it's up to you. You can think about it as long as you want, but if you decide one day, hey, today's the day I really want to learn this new skill of how to trade with Greg, all you have to do is reach back out to me and we can get it set up. But the course does cost $1,750, but I promise you it's worth every penny. I share with everything that I've learned over the last 28 years as a full-time trader, and I know you'll be glad you took the course. Now, if you like online courses, I have a great online course available at udemy.com. The link is in the description of this video. It's called the Deep Dip Buy Stock Trading Approach. I teach you step-by-step how to trade the deep dip buy approach. And a lot of the trades that I showed you today, a lot of these great trades and results that I showed you today came from that particular strategy. And the best thing about that Udemy course, it only costs between $12 and $15, and you get a lot of content. You get 26 videos, you get 9.5 hours of video, you get 15 study guides, and I've had so many great reviews and so much great feedback from that course. Do yourself a favor. Of course, the one-on-one is better because of the personalized attention and so forth. But if you're not in the financial position to take the one-on-one course, this is a great place to start, and the link's in the description. Thirdly, if you like today's podcast, if you found it valuable, all I ask is that you would please hit the thumbs up button. Helps to build the channel, helps keep the channel around. If you could share it on your social media, I would certainly appreciate that. Anyway, if you did find something valuable here, if you could hit the thumbs up button, I would really appreciate it. And then last, and always the most important thing, please try to go out and do something nice for someone today. It would make the world a better place if we all could go out and do one nice thing. It doesn't have to be big, just hold the door open, help someone if they drop something, or help them out one way or the other. It would make the world a better place. And if you could also do that for an animal, I would greatly appreciate that. I grew up with a lot of animals. I have a lot of love for animals, and they really love and appreciate acts of kindness to them as well. So just one nice thing for another human being, one nice thing for an animal, good karma, all that kind of stuff, and good for you, and it would make the world a better place. So I really appreciate you stopping by, spending the time here, investing the time. Hope you're learning something, and if you have any comments or questions, put them in the comment section. I will do my best to respond to them. And remember, Monday, the market is closed for President's Day, so we have a long weekend. And God willing, I will see you next weekend, and we will see how all these trades played out. But in the meantime, please be patient with your trades, position size, place your emergency stops, know where your end-of-day stops are, follow your process. It's the only way to make money in this business, everyone. And if I can help you with that, just reach out to me. My email's in the link of the description. So thanks again, everyone. Hope you have a great long weekend. And on the way out here, I have to run the U.S. legal disclaimer. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.